Welcome to Shark Cap Table. We are going to go through tab number 5, which is the red tab, Detailed Founder Valuation. Now let's be clear about the difference between detailed founder valuation and pre-money value. Pre-money value is what actually drives the calculations and the shares and the ownership that the investors ultimately have. And pre-money value is what they think you're worth. We set out to create detailed founder valuation, which is something to defend and bounce off what they have to say about the worth of your company. Obviously, the man who has the money generally controls the deal, but you have an opportunity to discuss why you think you're worth XYZ as opposed to minus XYZ. So, without further ado, let's go to section A, which is a discussion. You can read all about this. I've got almost a whole page here. Now we come down to section B, and these are talking points to support your detailed founder valuation. Don't forget that we move these off to the side. I would strongly suggest that you try to write down and answer these 12 points. And when you do that, you can use those also when you write your summary of opportunity in the executive summary for Light or the executive summary for Pro. Now, of course, the first founder valuation method is going to be our method. And this name is the name of our little company. And this is acquired by going and entering in the sheet Shark Cap Table Light section H. This is all locked down. Anything that's not blue is locked down. So if you try to change it, you're not going to change it. You have to change it over here at the bottom, down here. See? Right there. Okay, let's go back to page number 5. Now, again, anything that's in blue you can change. These aren't bad, but you might want to change them yourself. So the idea is you come in here and you will have already placed some cash into the deal. If you have any beta test revenues, the question is, if you got $50,000, should you do it dollar for dollar or 3 for 1 or 2 for 1? It all depends. These are all highly subjective and open for extreme discussion with everybody. So just because you put a number down doesn't mean it is the fact. What is a patent worth? Well, it depends on the value of the patent in terms of freedom to operate. A lot of people get patents, but they don't get a freedom to operate study, which could cost you a lot of money, but it could well be worth it. It's kind of like being in the middle of a forest and the trees are closely spaced together, and you get a patent, which is another tree in the middle of this grove, and you can't move around. But you got the patent, and that doesn't give you much freedom of operation. Trademarks and proprietary software, it could be 100,000, it could be 1 million, it could be 10 million. It all depends on what you think it's worth. Management expertise. These numbers here are not necessarily the salary. If you had like Bill Gates here, you couldn't pay him enough. The fact is that he formed a company, did so well, the value would be in the millions or the billions. Market size, the ability to capture share. Well, is it good to have 100% of a $10 market or a small percentage of a large market? The VCs and the professional guys always like you to investigate a market that could be $1 billion in size. You'd like to be the first mover without any competition, but we know that competition is fleeting and that markets change, and the key issue is whether or not you can jump on this market and make something out of it. So there it is, and we end up with a detailed founder valuation, which is simply the sum of all of these. Now, we also tell you whether or not you are up or down from the detailed founder value and the pre-money value, which you have over here in Light. If you come up here to this section right here, you're going to see that we've got 590 and everybody else says 500. That's the pre-money valuation. The pink simply means that the investors have less confidence in your numbers than you do. Let's go to Section D. Now, Section D is a summary of pre-money valuation methodologies. And there are 4 of them: the venture capital method, the Dave Burkus method, the risk factor summation method, and the Bill Payne or the scorecard method. Now, I left this one so that you can enter it yourself. This one's a little tricky. It needs a lot more local data, which I don't have. These are a little easier to use. And so what happens is we're basically going to go and try to get an estimate for each of these, and it will give you an average of the methodologies actually used. Then this, I strongly urge you to go visit Bill Payne's website. We have a listing of it down here. He's a very smart guy and has been around the business a long time. And he provided an interesting number, which was the average angel valuation for 2010. Remember, it was just 2 years after the Great Recession. So who knows, maybe this number is bigger, but it's an interesting one. $1.6 million is the average pre-money that is ascribed to an angel deal. I'll tell you that most of the deals that I've been talking about are $500,000, so maybe I ought to go visit these angels and get a better deal. You can see right here that we've got a $590. So here we are, the 4 valuation methods written by Bill Payne in this paper, and you can go to this site right there and get it. So the venture capital method, let's do it. Let's say we need to raise $300,000. These guys are always wanting a 10-to-1 on their money. Let's say the exit value is going to be $4 million. Now, by their calculations, the post-money valuation is going to be $400,000, which means your pre-money value is only $100,000. Wow. So if you're trying to raise $300,000, you need to prove that your exit value sometime out there is going to be in the $10 million range so that you can get a reasonable pre-money valuation. Remember, the bigger this number, based on our calculators, the more you own. The smaller this number, the more they own. So now let's go on down here to the Dave Burkus method. And again, I've given you the website. You can go read all about it. This is another good guy that's been in the business a long time. We all have something to learn from these experts. Now, his system is very similar to the system that we use. We have 6-7 types of components. And what he does is he basically says, look, you've got a quality management team, a sound idea, a working prototype, quality board of directors, product rollout, or sales. And he ascribes between $0 and $500,000 for each one of these. And you can either enter it in here. I like to use the spinners. I'm a spinner guy, so maybe we got a great management team, and maybe the idea is pretty good, and maybe we got a working prototype which is really great, and we bump that up to $400,000. And the quality board of directors, we don't have very many, and the product rollout or sales is a little bit dicey because we're not sure yet. Well, you can see right away that that gives you $1 million valuation, so you can play the game. You know, what is the right number? Well, it depends on how well you negotiate and who these people are, the resumes, the backgrounds, and how you ultimately present it. You know, a brilliant idea demonstrated or presented by a dumb guy is not going to be very good. Keep in mind that basically the top valuation is $2.5 million because 5 times 500,000 is $2.5 million. Although we can go higher. I let you go higher, so be careful about making these too bloated. What you don't want to do is come into a valuation that looks like $10 million for a PowerPoint. No one's going to believe you. Now, this is another one which I think is very interesting, the risk factor summation method. It's a little obtuse in that if I said I had a high-risk deal, I'd want to put a 10 or a 12 on it. But in this case, these guys put a negative number. And for example, a number 2, and it only goes between +2 and -2. +2 is a very positive for growing the company and executing a great exit. Number 1 is just simply positive. Neutral is it really doesn't impact the valuation. Negative is, things aren't going to go so well and it's not going to be a great exit. And number 2 is really a downer. So I've gone ahead and written, in my opinion, what each one of these should be considered, and every one of these has its own little yellow box. Now, what we do is we just come down here and we say, well, how good is the management? Is it a 1 or is it negative? Well, it's got to be at least a 1. Stage of the business. Well, if you had a PowerPoint, it would be a -2. If you had a business plan and no money, it might be, that. If you sold $5 worth of product over the last year, it might be 0, but maybe you got a 1 because you've been out there with some early stage revenues. Legislation, political risk, well, probably the business we're in doesn't make any difference. Manufacturing risk, we got those covered. Sales and marketing risk, well, do you have the brother-in-law set up? Let's give it a 2 because you really are out there pounding, doing a good job. Funding, capital raising risk, there's always a risk. Let's give it a 1. Competition risk, well, maybe there's severe competition. Technology risk, again, maybe there's some severe things about to come around the corner. Legislation risk, you don't have any. Reputation, maybe you engage in skydiving or very dangerous activities, or maybe you are a political firebrand, which could get, on the front pages of the newspaper. Potential lucrative exit, well, maybe it's going to be that. So ultimately, we've got, if you add these all up, you only got a 4. And basically, Mr. Whoever did this is saying you have to have $250,000 for each one of those. So select 250, and there's your $1 million valuation. And again, here's where you can get to the Bill Payne scorecard method. So I would just like to review that none of these methods ensures a good deal. It's a good idea to look through at least 3 or 4 of these methods and put them down and see what you get. Now, in this case, we had a 7, a 1, and a 1, and I just kind of flipped through and didn't really think about it. So there we have an average of 900,000. We've been saying we got a 590, and the Angels have a 1.6. So, we're in the ballpark. If anything, we're a little low there. But I like this method here because it really focuses on some important issues. So, do look at your valuations. Now, I'm just going to mention one more thing. When you come over here to the Shark Cap Table Fast, you can just circumvent all of that by just cranking in a great big number however you want, and it's a good way to start. I would certainly double back and try to justify that number, and you'll see the detailed founder valuation coming in here, leasehold improvements, etc. And if you add them all up, then you'll want to see how you compare. And when you come over to light, again, you could do the same thing. Here we have the cash that we put in. This is the detailed stuff. If you didn't want that, you could come back to the valuation and zero all these guys out. 0, 0, 0, 0, 0, 0. And there you are. This 100,000 needs to be taken out like that. And now you could just come in here, or you could group them all together, and you could put in 600,000, 700,000. And there, my good friends, is how you approach pre-money valuation, which is what the investors think you're worth, and you compare that to your founder valuation, which is what you hope you're going to get. I can almost assure you that whatever you think you're going to get, it's going to be lower than that, because investors have a funny way of chipping away at your strong points and piling on the weak points. Thank you very much. Don't forget, we have a whole series of tutorials that can go through and describe in detail what's going on in this powerful model. Thank you very much, and let us hear about your successes and hopefully few of your failures. Come to the website, www.sharkcaptable.com. Bye now.